Hey guys, welcome back. In this video I want to talk about the price earnings ratio and go a little bit more in depth about the price earnings ratio or the PE ratio as a stock valuation tool. So this is part one of a stock valuation method series that I'm compiling. If you haven't watched the first video that gives an overview of the different ways you can, or different valuation methods you can use to value stocks and shares, I recommend viewing that first, as these videos will just be more in-depth videos on each of these topics. So the price earnings ratio is one of the more commonly used stock valuation methods, in that it's often cited by mainstream media and used a lot by retail investors because it's a fairly quick and easy way of getting a rough idea of whether a company is overvalued or undervalued. So a common rule of thumb when it comes to the price earnings ratio or the PE ratio is that companies that are valued below 10 or 12 are considered undervalued, and companies that are valued above 20 to 25 are considered overvalued, with an average PE ratio generally being around that 15 to 16. So when it comes to calculating the PE ratio, people do it subtly differently, in the sense that some people use the trailing 12 months of earnings, or some people use analyst estimates for the next 12 months of earnings per share. Personally, I like to use trailing 12 months because I feel like you don't want to price in the future that hasn't necessarily come true yet. So whilst the PE ratio is a fairly simple and easy method of calculating whether a stock is overvalued or undervalued, its simplicity also ignores a lot of things, and so whilst it may be popular, it isn't always the most accurate tool to use to value the future prospects of a company or stock. So when you're investing in a stock, you're buying part of a company and you're buying the equity share of part of that company. But companies often have debt on their balance sheets, and so a stock price might only make up a small fraction of the total enterprise value of a company. And enterprise value of a company being one that includes, it's like the value of a company that includes both the equity portion and the debt of that company. And I'll talk about that in another stock valuation video, so subscribe if you want to watch that video. But when it comes to the price earnings ratio, because stock price is only reflecting the equity portion of the company, there's potential there that if the company is highly leveraged, that you only need maybe a small increase in interest rates or a small drop in profit margins, and that could have a very big effect on the company's profits, which the earnings per share part is representative of. So the PE ratio doesn't take into account the leverage and the debt and the credit on a company's balance sheet. The PE ratio also doesn't take into account the future prospects of a company, in the sense that it isn't considering whether the company's growing or whether it's in decline. It's just having a look at how the stock is valued relative to its present earnings. But if a company's in decline, you would expect that the PE ratio would be lower than 15, maybe even below 10, because the market is starting to price in that company going out of business at some point in the future. Maybe that's 5, 10, 15 years from now. But the point is that when a company has a lower expected return on equity in the future, you would expect a lower stock price. So as a result, expect a lower PE ratio. And on the flip side, if you've got a rapidly growing company, like some tech startup or just a new business that's really growing rapidly, you might expect a PE ratio that's much higher than 20 or 25, because if a company is growing at 20, 30, 40% a year, and if it can sustain that over 3, 4, 5, 6 years, that is going to produce a lot of revenue, a lot of potentially profits in the future. As a result, the market will start pricing in those future profits, and as a result, relative to the last 12 months profits, which a lot of the PE ratios are calculated on, the PE ratio might seem very high, but that doesn't necessarily mean the company is in good value. The PE ratio can also be a little bit misleading when it comes to industries that have a bit of cyclicality to them, in the sense that where profit margins of products vary depending on boom bust cycles of the economy. in the sense that when things are really booming, you might have quite high profit margins, and as a result, when things get a little bit tougher, you might find profit margins drop by half, which, you know, at that point, if you're buying that company on a PE ratio of 14, which might be slightly below average, but profits halved, that means that really you've just bought that company on a PE ratio of 28, which is overvalued. So the PE ratio doesn't take into account the cyclicality of that industry or the market itself or that particular company. And so in some cases, like in the mining industry, sometimes the PE ratio can be a pretty poor indicator of future prospects, because it's a much more boom bust industry where profit margins go from here to here very quickly. So as a result, some people like to use a PE ratio that is longer duration, or a cyclically adjusted PE ratio, where you might take into account earnings over the last 3, 5, 7, 10 years, and potentially even adjust it for inflation to try and smooth out the high volatility that can occur in some industries, and to give you more of an average expectation of what that company's earnings are, so that you don't overpay at the top of the market. So in that sense, the PE ratio can be a semi-useful tool for getting a gauge on whether the whole market itself is overvalued, because, you know, a whole stock index can be quite diverse, and if you take the earnings of all the companies in the stock market and compare it against the total market capitalization of the stock market, that will tend to be a lot more stable, so you can get an idea of whether stock prices are elevated or whether they're depressed. Or you could apply the same things to individual industries themselves, and sometimes using PE ratios to look at average PE ratios through history can give you an idea of, you know, some industries might trade on a slightly higher PE ratio, and some industries might naturally trade on a slightly lower PE ratio. So looking at where the company is at with its PE ratio relative to history might be a good guide as to whether a stock is fundamentally overvalued or undervalued. Another thing to be aware of when using the PE ratio is that the earnings per share is normally calculated on net profit. So net profit is often adjusted for a lot of things like depreciation, taxation, and interest expense and stuff like that. And so there's there can be a lot of accounting adjustments in a net profit statement or net profit result. So sometimes net profit can be overstated in a year or aggressively understated in a year if there's a big write-down or something, or if there's a one-time event. So sometimes the PE ratio can be distorted by these accounting adjustments. So again, you might want to use other stock valuation methods to just compare and contrast to make sure that the PE ratio isn't giving you a sort of like a false positive or a false negative. So to do that, you might look at something like EBITDA or something, so earnings before interest, tax, depreciation, and amortization. So things that might give you a better look at cash flows. In addition to that, there's also a number of times where a company might actually run at a loss in a year due to some one-time event, and might even have a negative PE ratio, which can often be a great buying opportunity, because negative events normally have result in a lot of people wanting to sell. And so as a result, you might have companies that trade on either a negative PE ratio, or if they've had a really small net profit for a year, they might trade on a ridiculously high PE ratio. But if you're willing to go look at the company, look at the income statements, look at the balance sheet, look at the company's prospects, and use some other tools to analyze the company, you might realize that even though these PE ratios are quite extreme, that the company itself might have some good fundamental value there. So there's a bit more to stock valuation methods, and whilst the PE ratio is a pretty crude and quick way of looking at stocks, it is only one of the tools I would use when analysing a company. Some of the other tools that I like to use more often, I'll talk about in the next videos. So thanks for watching, and as always, if you've liked this video, please like, comment, subscribe, and share it with your friends and family. Alright, see you in the next video.